Hi guys, so welcome back to the channel. So in this video, I'll be recording some additional questions in addition to what Sir has covered in class. So I'll be using the questions given in the prescribed reading material, that is Prasanna Chandra, and I'll be covering a few more questions. So firstly, I'll show you the questions so that you can take a screenshot. So this is the book that I'm doing it from. So there are some solved questions. So if you don't have this, so I'll send you the valuation, this one. Okay, so there are some solved questions. If you're not comfortable directly solving, you can refer to these questions first, and thereafter you can refer to the unsolved questions. So these are the 7 questions that Sir covered in class. So I think most of you will be comfortable solving these questions. So one question that I need to cover will be this one, which is regarding the taxation. Some people have some doubts regarding this. I'll also share my Excel sheet where I've solved the questions. So if you have any questions, you can directly refer to that. I'll also give a timestamp of the few questions that I feel are important, and I'll be covering only those. The rest you can try on your own. Okay, so firstly, if you want to do these ones, so you can take a screenshot. Okay, so now I'll be covering question number 6 because this has the tax element. Okay, so question number 6 says that you are considering investing in one of the following bonds. Bond A has a coupon rate of 12%, maturity 10 years, and price per 100 rupees par value is 70. Bond B has a coupon rate of 10%, maturity 6 years, and the price is 60 rupees per 100 rupees par value. Your income tax rate is 30% and your capital gain is effectively 10%. Capital gains are paid at the time of maturity, or the difference between the purchase price and the par value. So this 70 and 100, so 30 rupees, you have to pay a capital gain of 10%. Okay, so let's go to question number 6. I'll just move this a little down so that, so, right. So sir might have solved it a little differently than what I'll be showing. So if you have that, you can follow that. So what I have done here is basically I've taken the coupon rate. Here it's 12, par value is 100, so 12, like 12% of 100 is 12. So for the next 10 years, hey, you'll get a coupon. For the next 10 years, you'll get a coupon of 12%, which is this. And at the end of the 10 years, you'll get 100 rupees extra, so 100 plus 12. So 9 years, you get 12, and the last year, you get 112. And at the end of the year, so you bought this at 70 rupees here. And what I've essentially done is I've reduced the taxation element. So your income tax is 30%. So whatever you earn as income, you multiply that by 1 minus 30, which is 70%, and you'll get 88.4. And for the last year, what I've done is you're already getting 8.4. You have to pay additional tax of 10% on your capital gain. So your capital gain is 100 minus 70, which is 30 into 10%, so 3 rupees. So I've done 100 and on the 112, you'll get 100 plus 8.5, 8.4 minus 3. So 100 is your amount. This will not get taxed at 30% because this is your return on investment. The difference will be taxed. So this difference between 170, so that 30 into 10%, and this is already 8.4. So I could have written 100 plus 12 minus on this 12 it will be 7, like 30%. So essentially it's 100 plus 8.4 minus 3. Okay. For the second question, it was 10% for 6 years and you purchase it at 60. So minus 60 at the initial, then 10 rupees for next 6 years. And the last year you also get rupees 100. You put the taxation element, so 10 into 30%, reduce 30%, so 70% is 7 here. And then also you have to reduce the capital gain. So capital gain is 100 minus 60, which is 40 into 10%. So 100, this is 100 plus 7 minus 4. Okay, now you put the IRR formula over here, which is equal to IRR. Then select everything and give a rough estimate of what you think the rate is, and then press enter, you will get this 18%. So the question asks for a post-tax yield. So the post-tax YTM is 14% in this case and 18% in this case. Okay, I hope this part is clear. If you have any questions, just leave in the comments. I'll solve those specific questions as well. Okay. Now let's move to the additional questions. These were not covered in class. So you can take a screenshot. One second, I'll just zoom out. Or maybe take screenshot in 2 parts. Okay. So let's say 8 to 12, take a screenshot. And then 13 to 17. So leave 17. 17 was not covered in class. So 13 to 16, you can take a screenshot and try on your own. Obviously, as I mentioned, I'll keep a timestamp so that if you want to cover any of these questions, you can specifically cover those questions. Okay. So I'll cover question number 8 because that's the first question and I think it will give set a base. The share of a current of a certain stock pays dividend of 2 rupees. D0, which is 2 rupees last year. So it's very important to understand which is the dividend that is paid last year and which is the dividend that's going to be paid. Because the formula, if you remember, is P0 equal to D1 by R minus G. Now it's very important to understand which is D1. If you use D0, then the value will not be correct. You have to use D1. Now here it says dividend of the last year. So since because it's the dividend of the last year, it's D0. So D0 equal to 2. Here they've kindly given us that, okay, D0 equal to 2, but most questions will not give you this D0. So you have to understand from the language of the question that it's D0. So dividend of 2 rupees last year. The dividend is expected to grow at constant rate of 6% in the future and the required rate of return is 12%. How much should the stock sell for now? Assuming that the expected growth rate and required rate of return are the same, what is the price it should sell after 2 years? Okay, so the first important question is to find out the value today. To P0 is equal to D1 divided by R minus G. D1, so I have D0, so D1 would be D0 into 1 plus G, so 2 into 1 plus 1.06. So that will give me 2.12. And P0 would be 2.12 divided by R minus G, so 12 minus 6. So that will give me a value of 35.33. This is the value of the stock today, which is P0. Now you have to calculate the value of the stock after 2 years. So today it's P0. After 2 years, the value would be P2. So P2 equal to P3 divided by R minus G. Here it was P0 equal to D1 minus divided by R minus G. Here it's P2 equal to D3 by R minus G. Okay. So this, the third year's dividend will continue forever. So what you can do is calculate the third year's dividend in the same way. So first year's dividend will be 2 into 1 plus 02. 2 into 1 plus 06. Third year's dividend will be 2 into 1.06 to the power 3. That will give me a value of 2.38. And if you calculate the P2 equal to 2.38 divided by 6%, which is 39.70. Okay. Alternatively, you could have calculated it as 35.33 into 1.06 to the power 2, because that's being compounded forward, but this is the ideal method we are using the formula. Okay, this is called the dividend discount model. Now, based on this model, you can also solve the other questions. Okay, I'll show the solution so that in case you have solved it. So this is question number 9. If you have solved it, it's very similar. You can find the solution. In case there is any discrepancy, please let me know so that I can correct them. Okay. Okay, now moving to question number 10. This is also very similar, so I don't think there's any need to solve the question. You can take a screenshot. This one, question number 10, or I'll give you the Excel sheet anyway. So if you want to use that, that's okay. Very good. Okay, so in this question, what they were asking is that if 32 rupees is the price of the share, and D1 is given, R is given, G is not given. So you have to calculate G. In just the same way, use the formula. So the price it's selling for is 32. So we assume that it's selling at the price that it should be selling at. So that's why we are using that as P0. So G will, if you calculate and calculate this one, you will find that G comes to 5.75%. Question number 11 is also very similar. Let's see. Facing gloomy prospects, the dividend. Okay, so in this case, what was happening was, what's unique in this case was dividend and earnings are declining at the rate of 4%. So what you have to do is G is getting -4. Okay, the previous dividend, again previous dividend, here it's in previous dividend. So previous dividend is D0 and not D1. So D0 is 1.5. G is equal to -4 because it's reducing, and you've not been given R. You have to find R. P0 is given, so the price of the value of the share today is 8. D1 is equal to 1.5 into 1 minus R. So instead of doing 1 plus R, I'm doing 1 minus R. So that will give me 0.96, which is equal to 1.44. Now use this value to calculate R and you'll get 14%. I'm just quickly running through these because I think these are simple enough. In case you have doubt, you can refer to the solution, and there are formulas that are linked here, so you can directly check that how that has been derived. Again, if there are any because I solved them quickly, so if there are any mistakes, please let me know. Okay. So this question number 12 is something very similar to what's taught in class today, which was the two-stage dividend discount model. Here it was basically 3 stages. That they said that firstly it will grow at 12% for up to 4 years. Then it will grow at 8% for the next 4 years, and then 5% in perpetuity. The price of the last dividend, so last dividend is D0, is 1.5, and the investor is required to investors required rate of return for the stock is 14%. So you have to calculate the market value of the share. Okay, so this is a little bit tricky because you have to calculate it in multiple stages. So the first dividend is calculated as 1.5 multiplied by 12%. So it gives me 1.68. This is also 12%, 12%, 12%. Then you increase it by 8%, 8%, 8%, 8%. Now the next one, you have to calculate it on the basis of the 5% incremental perpetuity. So you use the formula of D1 by R minus G. So in that case, what you do is basically calculate the D9. So you're calculating the value of that share on at the end of year 8. So P8 equal to D9 by R minus G. Okay. So this part is the PVIF at 14%, which was given in the question. So I hope this part is clear. So you use 3.21 multiplied by the growth rate of 5%. So 3.21 into 1.05, that is the D9, and then D9 divided by D9 divided by 14 minus 5. So R is 14 and G is 5. So 14 minus 5 is 9%. So that 3.21 multiplied by 1.05 divided by 9%. That will give you 37.46. And if you use the PVIF formula over here, and then multiply the dividend into the present value factor, you get PVS. Okay? And you add them up, and then this is the P0 today. Okay? I'm just going fast with these questions because I think most of it is simple. If you have any questions, if you want me to specifically solve any specific question, let me know in the comments. I'll make a specific video for that. Okay. So question number 13 you can try, because this is based on the two-stage DDM, because there are two growth rates, one up to 5 years and then next one is beyond 5 years. So I think this one you can try very easily. Question number 14. Okay. Question number 14, I have to check because I calculated the YTM, which is coming to 4.17. But this part is not clear to me as well. If the reinvestment rate applicable to the interest rate bond is 16%. I don't think sir has covered this part. I have to check this part. So leave this question pending till now. Okay. 15 is a good question. So 15 is based on so again 15 is very same as 13. Only what it has asked is, instead of asking for the price, it has asked for the intrinsic value of the share. So the intrinsic value is nothing but the value that should be in the market. So you might get confused with the word intrinsic value. Intrinsic value is the underlying value of that share. So whatever we have been calculating P0, so instead of writing P0, you can also write IV0, which is called the intrinsic value of the share. And basically what we have been doing is we are saying that the intrinsic value of the share should be equal to the price of the share. That's why we have been writing as P0. But actually it's the intrinsic value of the share. So intrinsic value is the underlying value based on some factors. So here we are using the dividend. So the dividend discounting model gives you the intrinsic value of the share. So it's the same as 13, just the word intrinsic value is new. So rest you have to do the same thing. And then lastly 16. Okay, so 16 I don't think might come, but then I've just for the purpose of solving, I've just solved it, because in case it comes you can refer to it. So in 16 what they've said is they've taken instead of what was happening in the last few questions is, okay, for the next few years it's 20% and then it becomes 10% all of a sudden. But in real life what happens is it's 20% and linearly it starts falling down. So 20, then 18.75, then 17.5 and so on. It starts falling linearly and then reaches 10 and stays stable at 10. Okay, but so in this case what they have said, it's 20% and it linearly falls to 10 and then stays stable. So what we have to do is we have to calculate the growth rate for each year. So what I've done is that difference of 10 I've covered over the 8 years, and there is a fall of 1.25% every year. So you can see the first year is 20%, then 18.75, then 17.5, and so on till the 8th year when it reaches 10% basically. Okay. So you can see the solution. I think it will be self-explanatory. We see the solution, and I'll post this document for you guys to refer to. I'm sorry I just ran through all the questions because I'm also not feeling 100%. So I solved the questions, refer to the Excel sheet, and probably understand most of it. If you don't feel confident about a certain topic, let me know. I asked in my class, they were confident about bond valuation, equity valuation, and they said only just do the sums. So that's why I just recorded the sums first. If you want me to do a revision video, I'll also make that tomorrow. So don't worry, just let me know that if you want a revision video on bond valuation, equity valuation, I'll make that video also. Okay. So thank you for watching the video. stay alive, and yeah, thank you so much. Stay safe. Okay.